Okay, folks, the Enzo Di Cosenzo podcast. This is part 5. So let's get right to it. Part 5 of the macro section of or the macro topics of both of these. Whoops, didn't want that. Of both of these courses. We're looking at the macro section right now. So yeah, so this is the federal funds rate that we're going to be discussing. And this is in your reading packet for under the final exam. Look for this article, federal funds, and mine's obviously highlighted a little bit more. But everything you're hearing in the news, interest rates this and interest rates that, that's what this is. Okay, so it refers to the target interest rate set by the Federal Open Market Committee. It's the rate at which the commercial banks borrow and lend their excess reserves to one another overnight. The discount rate is borrowing directly from the central bank, which is a little bit higher, and attempts to discourage that when the capital is sloshing around the system as is from one commercial bank to another. The U.S. central bank prefers that commercial banks get it from other commercial banks, not from the central bank. It's the policymaking body of the Federal Reserve System. It meets 8 times a year, and for years I've been a Fed watcher. That's what a Fed watcher is. It sets a target for federal funds rate, and which is part of the monetary policy, managing the money supply. And we've discussed what the U.S. Central Bank of the Federal Reserve is in the last couple of videos. And it's obviously at the end of the day, what are we doing? We're trying to promote economic growth. So today's lecture, it's part 5. Yeah, part 5. So we're going to look at actually an analysis of Silicon Valley Bank by a recent Nobel Prize winner in economics. We're on the federal funds rate now. And then we'll talk about Treasury. So we'll nest these in between some of this other. Since we already started talking about the federal funds rate, let's just roll with that. So it's the target interest rate set by the Federal Market Committee. It's the rate at which commercial banks borrow and lend their excess reserves to each other overnight, and it sets the target federal funds rate 8 times a year based on prevailing economic conditions. Employment's a big part of it. Inflation certainly is a very gigantic part of it. It can influence short-term rates on consumer loans, credit cards. And certainly people who want fixed income investments, that you're going to be happy when this goes up. That's for sure, at least for a time. Is if you can lock in some good return rates in fixed income for quite a while, then what the market does. I'm not saying what the market does doesn't matter unless there's a default, but what the market does doesn't impact you as much unless there's a default on one of your lendees, the people you're lending to. Yeah, this is the same thing. What the federal funds rate is. By laws, banks must maintain a reserve amount equal to a certain percentage of the deposits in an account at the Federal Reserve Bank. The amount of money a bank must keep in the Federal Reserve account is known as the reserve requirement, and is based on a percentage of the bank's total deposits. If you do become a banking analyst like I am, you'll get very used to these ratios, and that's going to be a big part of what you're sort of studying and what you're trying to do here and what you're trying to look at. I'm always cleaning it up a bit. But financial institutions are required to maintain interest-bearing accounts at the Federal Reserve Bank to ensure they have enough money to cover deposits or withdrawals and other obligations. Well, I mean, look, you can't have 100% insurance. The government, I hate to say it, but the government supplements the backing of the bank's liabilities with taxpayer accounts. That's terrible to say, but that's really what happens. Any money in their reserves that exceeds the required level is available for lending to other banks that might have a shortfall. The end of the day balances in the bank's account average over 2-week reserve maintenance periods are used to determine whether it meets its reserve requirement or not. And again, is it a 30-day period? Is it a 15-day period? You'll capital adequacy ratio. Those are all the general term is a capital adequacy ratio. How you're going to cover your liabilities and what you're going to, what assets you're going to sell to do that, or your cash. I mean, if you have $100 in deposits and you just keep $100 sitting there, there's really no point to being a bank, right? You're going to take 70 or 80% of that $100 and do something with it, buy real estate, speculate in the market, debt instruments, or whatever it might be. And then you're hoping to get a better return. It's like you're planting a banana tree and you're picking off a banana for your customers. That's about what you're doing. So yeah, it's the lending the bank can charge the interest rate. The lending bank can charge is the federal funds rate or the federal funds. I don't know. It says Fed fund or the Fed funds rate. That's a sort of an abbreviation for it, but that's fine. And yeah, these are very highly educated economists that work in the certainly work in the U.S. central banks, that they're really measuring key economic indicators that show signs of inflation, recession, business cycles that can affect the sustainable economic growth. The indicators include measures like the core inflation rate, the durable goods order, and there's a whole bunch of others. The majority, you would have a hard time distinguishing between an economist at the Federal Reserve and an economist at a place like Rutgers, because they're very similar, academic types, sort of ivory tower, Ivy League type folks. Uh, Powell, being the Federal Reserve chairperson, is an unusual move. He's a real practical. He's a lawyer. He's not a PhD in economics. He's a very practical guy, but certainly richer than probably a lot of those guys by a lot. I saw what his net worth was. His boss is many, many times his net worth, but Jay Powell's done. None of us would argue with what his net worth would be. And so again, I had a student comment about that noise. Sorry about the noise. And what am I going to do? So, but yeah, so he's a very practical guy, and he's trying to make the central bank a little more street. I hate to say street smart, but that's probably the word, a little more street smart. So the effective federal funds rate since 54, it lowers the rates in order to stimulate economic growth. So again, when it goes up, what's the sort of the sentiment or the idea behind raising interest rate? When it declines, what are we trying to do? So it says that the Federal Reserve lowers, the U.S. central bank lowers interest rates. The idea is to stimulate economic growth. So lower financing costs can encourage borrowing and investing. Okay, that's the whole idea. Okay, behind lowering, and we've had very low rates, all the Obama years and a lot of the Trump years, but Trump, kicked it up a little bit. And like Rubini at NYU said, it's a very unnatural environment. What's going to happen in an unnatural zero interest rate economy, zero interest rate world? What is that? What's that world going to look like? Okay, that's really what we're that's really what we're concerned. Yeah, I would say concerned about, but that's what we're thinking about here. What is this? I heard Obama. Just it was in passing, but I heard Obama say make us a comment or a quote saying, "Well, if we keep printing money, what's really going to happen?" So that was his learned assessment of that. It says, however, when rates are too low, they can spur excessive growth and subsequent inflation, reducing purchasing power and undermining the sustainability of the economic expansion. When there's too much growth, the Fed can raise interest rates in order to slow inflation and return to more sustainable levels. Okay, so that's sort of where this 5-line paragraph here. That's really what it is. That's really what's going on here. So, now we didn't really seem to have inflation. So to sit there and say, well, no, low interest rates caused inflation, it's not the only reason. Okay, there's other forces at work here. Unfortunately, the energy dependency, since we do have a petroleum-based economy, energy dependency and buying oil from other places, that was a huge factor in why we're experiencing twice the price of a dozen eggs, from $2 for 12 eggs to $4 for 12 eggs from a year ago, or something to that effect. That's why we're seeing that. It says the federal funds rate has varied widely over the years in response to the prevailing economic conditions. It was set as high as 20% in the early 1980s in response to inflation. With the coming of the Great Recession, 7 to 9, the rate was slashed to 0 to 0.25% or thereabouts, again, to encourage growth. I think I updated this because I guess we just had the February. Well, it says February 2023, but it was January and then it was March. So it says February meeting. I don't think we had a February meeting. The rate was 4.25 to 4.5, right? And then that was the target for December. So let's see. I'm on page 57. If you guys can bear with me. Yeah. 4.25 to 4.5. And what do we have here? Yeah, 4.25 to 4.5. That was the target set for December. At the February meeting, that stuff just sort of came out, but we would have to look at it. But certainly, I think it was a quarter point movement to 4.5 to 4 and 3/4. So I must have updated this while I was getting ready for your getting your notes ready. It says it cannot force banks to charge the exact federal funds rate. It sets the target rate as a guidepost. The actual interest rate is lending will be charged determined by negotiations between the banks. In other words, it's market determined. The weighted average of interest rates across all transactions in these commercial banks is the effective funds rate, and we will graph that a little bit. Actually, after discussing this, we'll graph that. That's what I was looking for. Okay. And one more time for good luck. There it is. Sorry again. Sorry. Someone said that noise is all over your videos. So sorry about that. It can mandate a particular federal funds rate. The system can adjust the money supply so the interest will move towards that rate. By increasing the amount of money in the system, it can cause rates to fall. And conversely, by decreasing the money supply, it can raise interest rates. Increasing, decreasing. In the system, what we're doing with right there. Okay, so that's how this gets adjusted. The Federal Reserve System. Boom, boom. Okay, adjust the money supply, so you should move towards the target. This is stuff I'm sure it's on many students' minds. You know, what does this really mean, and all that. So hopefully now you have a better idea of what that means. Besides the Federal Fund rate, the Federal Reserve, which is not is I don't see this in the notes, the FOMC notes, but it's got to be somewhere. It's got to be released, right? Also sets a discount rate, which is the interest rate the Fed charges banks to borrow from it directly. This rate tends to be higher than the target federal funds rate, partly to encourage banks to borrow from other banks. I think I said that at the beginning. At the lower federal funds rate. Okay. And then we'll look at the difference in treasuries. We'll look at that next. And it says the impact of the federal fund of what this means. It's one of the most important interest rates in the U.S. economy. It affects monetary and financial conditions, which in turn have bearing on critical aspects of the broader economy, including employment growth and inflation. Okay, which are certainly big parts of the economy. The rate also influences short-term interest rates for everything from home and auto loans to credit cards, as lenders often set their rates based on the prime lending rate. So, right, loans for cars, credit cards, and the prime rate is the rate the banks charge the most creditworthy customers. It's also a rate that's influenced by the federal funds rate. Investors watch this. The stock market reacts to this, dramatically a lot of the time. A decline in the rate. What does this mean? A decline in the rate means that we're trying to encourage business. It can prompt the market to leap higher as borrowing costs for companies get lower. But also, that's sort of the easy answer in a sense where, okay, well, we have a lower federal funds rate. We're going to have lower borrowing rates. So it's going to mean companies are more profitable. But why are you lowering rates? You're lowering rates to encourage activity. So are there other forces and other factors that are keeping the economy from growing or functioning or expanding at a rate that we, at a pace or a rate that we would prefer if we didn't have to raise interest rates or lower interest rates rather to encourage. So if we're not trying to encourage activity, why are we lowering rates? So you got to temper which one of those forces has more influence on the value of aggregate equity. With the stock market is just the market value of aggregate equity in all these companies, 503 companies in the S&P 500 and so on and so forth, and the Russell index and all that other stuff. Analysts pay attention to members of the FOMC to try to get a sense of where the target rate might be headed. And there's a bunch of questions here. How does the federal funds rate work? How is it determined? What's the difference between federal funds rate and regular interest rates? That actually, the last one is really an interesting one. Certainly these are two of the most important indicators, and in the United States, and the chief distinction is the federal funds rate sets the range that banks will lend or borrow to each other overnight because it impacts borrowing costs and financial conditions. Stock markets are sensitive to these changes in rates, and the federal funds rate also indirectly affects short-term interest rates. Conversely, interest rates which are set by the Federal Reserve determine the rate that it costs for banks to borrow. Okay. It's a term now, this is believe me, I'm sure there's a very technical model that it sort of spits out what we think this should be, but certainly it's done quantitatively. There's no way that it's not. These rates are influenced by economic indicators, core inflation rates. So there's all sorts of inputs that are input into the model. And Jay Powell has said that at the meetings. He goes, we try to update our model as we're having the meeting, as we're having press conferences that explain what the latest FOMC meeting. And this is just the definition of what this is. We've seen this a bunch of times. Okay. So we checked off the federal funds rate. And now, if you guys don't mind, that we'll do this. We will go to St. Louis Fed funds. I think we do a nice monthly on this. Yeah, I just typed in what I'm looking for. And it's a Google search, not even the search of the St. Louis Fed. And this goes back to the 50s, which is wonderful. But that's I feel free to study it that far back if you wish. Don't let me stop you from studying it that long ago. But I think we've been going back to the 1st of January, whatever it was. Yeah, the 1st of January. And yeah, I think the only choice you could do quarterly, but I'm sticking with monthly. So that's 12 of these a year. So I'm going to stick with that. Okay, and you can see what this. Now this is a live graph, and obviously this is the pandemic recession, which was right there. But certainly we reduced interest rates dramatically to spur activity, and we kept them low for a good 2 years. They were kept low, and now again, if you're a fixed income investor right now, you're a happy guy because you're getting a probably as good of a rate of return as you're going to get. But then there's an argument that says, hey, inflation's still too high, unemployment is still too low, still too many people working, so we really need to lower this. We really need to raise this interest rate past the inflation rate and all that, by twice the amount. So you hear people make those arguments. So just be aware of that. We're going to download it into Excel. This is a quick and easy graph to sort of get our hands around. And then we'll go through the different types of bonds, and because we've graphed a 10-year or 2-year or 3-month. We've already made those graphs, and so I want to tie those together a little bit. And there they are. Okay. And again, if you guys don't mind, we're going to have to do our editing here. We'll edit. Oh no, we didn't have to do the editing, which was good. Okay, we don't have to do it. Okay, so you go to your Excel, and again, folks, if this is missing or whatever, you can't find it. It should be the federal fund. Just arrow over, you should be able to find it. But yeah, this is the file, the spreadsheet file again, the same spreadsheet that we've posted for you guys. So you have this, and however many of these we have, we go back a couple years, it's not going to be that much data. It's 60, 70 pieces of data. But again, where it comes from, what it is, all these things. So we're going to pick these off. Numbers. And I think you might have to, the last, I think we didn't have the last one. Yeah, so actually these horizontal lines are actually pretty good. So we're just going to take this, we're going to say copy, paste, format, escape, and then control. So you can see now you're up 4.57 for the effective federal funds rate. And again, just a couple years ago, it was 21, it was near zero. The end of 20, it was Trump was boosting it up a bit, because people were in his ear saying, this is not natural. This is not natural, right? People were saying that in his ear. Now, in terms of the percentage, that's not really going to have a hell of a lot of meaning, how much this changed. But you just make a nice graph of this. Yeah, I can reuse a graph here. Let's go out of character for a second and just do insert, scatter, make a graph, right? Like that, and then click on the chart title like that. Select data. Oops, I want to get this off. Select data, edit, X, shift control down. And this is effective rate. Oops, I don't want capitals for that. Okay, then you go to layout, legend, top. Okay, you have your 60, and we'll clean this up. You have your 60 pieces of data here. Whoops, what happened with the effective here? Select data, edit. Oops, we didn't do this. Yeah, those are your dates, and you can right-click, format these things. Alignment, you can make it, -75. You could do that. Options, not 500 days, maybe 300 days. A little bit better, right? That's the month, and you could even add, have the number of months. This is percentage. Okay. That's federal funds rate. Go around this thing. We can make it gray. Go around this thing, make that gray. Whoops. Like that. We did the whole graph is gray. I think that's what happened here. Border. There it is. You got to be careful what you're clicking on. And again, you always want to make this bigger, as big as you can. And these, you could shrink this a bit to 9, right? Something like that. You can shrink these percentages to 9. Okay. You don't need all these, the grid lines here. Right click, format the axis, or format the plot. Shadow, do a shadow. Fill, very light, fill. Okay, and with the grid lines, I mean, you could really thin these out. Solid style, make it thin, dashed. The color, let's do a purple, something like that. Okay, very light. See? So we did rather, and here you could jam in a couple more of these here. What do we do? 300. Let's do 200 days. Even 100 days. Yeah, something like that. See? There you go. Yeah, this is the effective monthly rate. Okay. You cut this. Find where all your graphs live, which is here. And you just keep stacking them up. So when you do your document, right, it's looking good. You have a good looking document that they hand to people. Right there. And then save this. That's your federal funds rate. Okay. And here we did this is the percentage change here, and I didn't do a percentage change for the I didn't do a graph for the yields, but I could have for the debt interest, but I could have done that. Okay, but yeah, so there you have your graph. Okay, you have your graph for this. That's your federal funds rate graph. So that you have. Okay, this is data. You don't need this data. Okay, so we don't need. Okay, so that's like that half hour is sort of done. And then actually, and what we'll do, because we'll get the treasuries, but here let's do a summary sort of in between with this. We had Moody's. Yeah, we have sort of an introductory version and a longer version. So here, let me just do that. It says Nobel Prize-winning economist debunks 3 misconceptions about Silicon Valley Bank's collapse. And this is just about a week ago, 10 days ago, something like that. It says whoever this was Douglas Diamond. I think I've heard that name. It says he knocks down some of the common misperceptions that caused the crisis. He won the Nobel Prize, whatever the year. He says it says last year, 2022. It says Silicon Valley Bank was a sound business wrecked by a stampede. No, it says Diamond's work shows a panic can ruin an otherwise healthy bank, but that wasn't the case here. So, and like with Credit Suisse, they were trying to get more capital injection, change leadership, but it's your business. What is your business? Can you define your business and what kind of business you're going to have here? So it was a victim of overly aggressive Fed rate increases. And again, also not the problem. Fed policy played a role, but it wasn't the main cause. And it says social media fueled the bank run. Not really. It says most of the venture capitals involved could have gotten the word at Rosewood's Sandhill Bar or any number of closed chat groups, but they didn't need a global media platform. So what went wrong? It says this bank failed because it violated the most basic rule of banking. It failed to diversify. It says banks make safe assets out of risky ones by diversifying. Okay, and look, any academic is going to love that word because there's statistical work that's involved in statistical. I don't say proof, but you can support it with a statistical argument that may or may not be accurate. But the academics love a statistical analysis because that's what we're in business for. So but diversified funding sources so the depositors don't need all their money. So again, cash, debt instruments, some other kind of asset. Okay, and we were just looking at those with the guys I work with down in Florida. We were just looking at that. It says make loans, taking deposits from the smaller insular group of venture funded tech companies who ran into trouble at the same time and ultimately ran for the exit together. So in other words, the profile of your depositors was the same. So in other words, they all sort of ran into headwinds with their businesses at the same time. Okay, that's the danger of being a regional bank. You have a very similar characteristic to all your depositors. So if they all say, "Hey, we need our loans back," and the loans are the basic asset of a bank. That's the basic asset of a bank. So if those aren't performing, you're in a lot of trouble. Which is now, I guess this was on the way to that, on the way to what happened in Greece, on the way to what happened in across the map of time, what's happened in banking. And so secondly, it says the regulators failed to anticipate how the business would be affected by rising interest rates. I don't know how you can miss that, but it says which by the way was not exactly a black swan event. It was not. Okay, anyone with rudimentary knowledge of economic history knows the day would come when the rates would return to something more, or the rates would turn to more something like I see how I'm thinking, how the rates would return to something more like their historical norms, and Silicon Valley match of short-term deposits with long-term treasuries couldn't survive the inevitable. Wow. Okay, but that's sort of a summary of this. It says, why didn't someone see the problem earlier? They're using the word collective psychosis, but the evidence was there, but no one was looking. So, okay. And actually, we may push that other one. We may not need this one. Yeah, we can put this in another because it'll be a similar conversation. So we'll put that in another video. But there you go. You have that discussed. Treasury bonds, notes, and bills. And again, we've looked now. We didn't look at bonds for 30 years or whatever it is. But here, let's go through the definitions of this. It says federal government offers fixed income securities to consumers and investors to fund the operations of its government, which is basically the federal government is a big gigantic company. All right, Treasury bonds, notes, and bills. And they're a debt instrument which investors are lending to the United States government. The purchase amount of the bond and return, investors are paid interest. And when the bond matures, investors are paid the face value. Okay, so now with the Treasury bills, that's a short term. You pay something and you're supposed to get face value. Certainly, if you're paying more than face value, that doesn't make a lot of sense, right? To have a security like that. Okay, so you pay $980 and you're getting $1,000 in 3 months, something like that, and that's about where it is. That's where about the treasuries are, something like that. And it says, in return, investors are paid an interest or rate of return when the bond matures or the maturity date. The investors are paid the face value of the bond. Notes, bonds, and bills have different maturities and can pay interest in different ways. All treasuries have zero default risk, meaning they're guaranteed and fully by the faith and credit of the United States government because we have so many taxpayers in this country. That's why. However, the safety offered by treasuries comes with a lower return on investment and the alternative riskier counterparts, corporate bonds. So again, Johnson and Johnson, it's unlikely, but Johnson Johnson could capsize, and a lot of companies can. Right, but it's unlikely that that'll happen, but it's certainly possible. Treasury yields rise and fall based on the price in the market, market and economic conditions, and yields fell significantly for a variety of reasons. Well, yields fell significantly because number one, the interest rates were the federal funds rate was low, and number two, see now what happened with COVID was a result of the rates being reduced dramatically and people hoping to get a better return in equity. So capital flowed out of debt, which lowers the price and can certainly increase the yield. Or in the reverse, it says yields fell. Well, yields fall means there's a lot of capital piling into treasuries because we don't have confidence that the markets and Walmart and whatever it might be are going to do very well during a certain period of time. And we prefer a known return. People bid the price up of those instruments and raise the price. When you raise the price, you're narrowing the yield or shrinking the yield. But that's what it means when it says yields fell. But also, though, the other version of that is the new treasuries that were issued were also at a lower coupon face or coupon rate. Okay, that's another. Again, there's a lot of forces at work in this. It's not just one. It's not as simple as here's an explanation of what's going on just in one sentence. There's a lot of things going on. But basically, the maturities are the differences here. These are the maturities. Okay. Treasury bonds mature in 20 or 30 years, offer the highest interest payments, and it's twice a year you get a check. Notes are 2 and 10 years. Again, that's what we've graphed right now. We didn't graph the 30-year one, but they have a little bit of a lower yield, and then bills are short, right? It's weeks, 52 weeks to a couple weeks. And you go to the website, the Treasury's website, and stock up on this stuff. So let's look at bonds. Okay, these are terms of 20 and 30 years. These are the long bonds. They take the longest to mature of all the government issued securities. They're offered to investors in terms of 20 and 30 years until maturity. The purchasers receive fixed interest payments every 6 months. Upon maturity, the investors paid face value. The bonds pay the highest interest income compared to notes and bills because the investors are compensated for locking up their money for the long term. And the same reason the prices at which they're issued fluctuate more than other forms of government securities because you have a hell of a long, you have 2-3 decades of exposure. They're issued monthly online with auctions held by the Treasury. They're multiples of $100. The price and the yield are determined during the auction. After that, T-bonds are traded actively in the secondary market and can be purchased through a bank or a broker. So, in other words, existing debt instruments. What do you do at maturity? If Silicon Valley Bank could have just held their debt instruments until maturity, they'd been okay. But they had to sell because the depositors were demanding their money back, and the loan portfolio most likely wasn't performing, wasn't giving off cash flow, so they had to sell some assets to do it. That's what happened with Silicon Valley Bank. It says investors can hold the bonds until it matures, redeem it for cash on the maturity date, or they can sell the bond in the secondary market before it matures. However, the face value is not guaranteed if the bond is sold before maturity, meaning investors could incur a loss when comparing the purchase price and sale price. Investors must, there you go. It must hold the T-bonds for minimum 45 days before they can be sold on a secondary market. So, the face value is not guaranteed before maturity, meaning the investors could incur a loss when comparing the purchase price and the sale price. So whatever the price is in the market, it may not, and you've got to do the math on that and what the return is going to be. So there's a dollar value for the price of all these cash flows that are, if you have a 20-year instrument, you're selling it, whatever, a year in or whatever. So those 19 years of 2 payments or whatever that is, 48 payments or something like that, right? Or 38 payments. Yeah, if it's a 20-year, because a 20-year has 40 payments, 19 years has 2 less, 38 payments. Okay, but again, you've got to see if there's people are paying you a lot, you could profit from that depending on the conditions in the market. Investors with these accounts can have the proceeds deposited directly into their bank accounts on file with the Treasury maturity. Investors can also reinvest the proceeds in other Treasury instruments, and those who have Treasury bonds held by their bank or broker should contact those institutions and determine their redemption procedures. These are supposed to be risk-free. And the idea is you're receiving a steady income from a government that you should believe in. So can be used for saving for education or major expenses. Many retail and institutional investors use treasuries to diversify the equity portfolio. So the bonds offer reduced risk and volatility while providing a stream of income. Sure, I mean, that's true. You've heard me knock the whole volatility risk, the whole portfolio theory, folks, but that's not true. I'll say it like that. Bonds, notes, and bills are sold before their maturity date could incur a loss. And Silicon Valley Bank learned that lesson, depending on bond prices at the time. In other words, the face value is only guaranteed if the treasury is held till maturity. Okay. So that was bonds. Now these are notes, shorter duration or shorter, time horizons, 2, 3, 5, 7, 10 years. They're backed by the government. They also pay interest every 6 months till they mature. They pay less interest than the bonds, and the notes have shorter maturities. And the T bonds, the yield is determined at auction. And upon maturity, the Treasury notes pay the face value of the bond. They're auctioned at the Treasury and are sold in $100 increments. And the price of the note may fluctuate based on the results of the auction. It may also be equal to or less than greater than the note's face value. Okay. They have the same redemption options as bonds and can be held to maturity or sold in the secondary market before they mature. It's a closely watched debt instrument. It's used as a benchmark for banks to calculate mortgage rates. It's in high demand the 10-year a lot of the time. It's considered a safe haven in volatile times. And again, the investment, the portfolio folks, like to, manage the risk, right? That's the appealing word to make people, sit up and take notice, right? And during a recession, the demand for the 10-year can increase, leading to fluctuations in prices and yields. And during risk expansions, the investors might sell the note and opt for higher yielding bonds since there's a reduced risk of loss during the expanding business cycle. And the 10 years is popular with institutional retail investors as well as central banks and governments. As a result, there's a healthy, steady demand for the 10-year note, providing ample liquidity. Treasury bills have shortest terms of all, are issued in 8 and 4, 8, 13, 26, and 52-week situations. So that's the bills. They don't pay periodic interest to investors. They're auctioned to investors at a discount to the face value, and the investor's return is the difference between the face value and the price paid at when it's repurchased. So an investor might purchase a treasury with $1,000 face value for $950. At maturity, the investors paid the $1,000. So the $50 difference is the return. So it'll be 50 over the 950, whatever that actually comes out to be. Right, equals 50 divided by about a 5% return. Not bad. Not bad if that happens. Zero default risk. They're backed by the government. They pay less interest than corporate bonds, and the corporate bonds have the potential of defaulting, which leads investors to demand higher interest rates from corporations to compensate for the added risk. This thing, I don't have a hell of a lot of experience with it. These are the questions. It says the Treasury also offers this instrument. It's a short-term security like a T-bill called a case management bill. The main difference is it has a shorter maturity date. It can be 7 days to 3 months and can be purchased in $100 increments. Can direct their federal tax refund to an active Treasury account to purchase securities. These securities are sold through auctions by the Treasury on the website. And again, setting rates and yields during the auctions, and the values fluctuate with the interest rates and the change in the market demand. Okay. All auctions are open to the public, can be found on Treasury's list of upcoming auctions. Individual investors can purchase securities directly through the auction process or a broker bank. They're announced a couple days before they begin. There's competitive bids, non-competitive bids, and also whatever instruments are going to be sold. There's an amount, what the maturity dates are, kind of a thing. So competitive bids, you're setting the rate just based on the price, basically. And it says competitive bids are limited to about a third of the offerings, and then non-competitive, you agree to pay the yield or discount margin set during the auction. Yeah, the best return you can get based on the auction, you agree ahead of time for that. Okay. And it says bidders are limited. You can't buy more. One person can't buy more than, or one entity can't buy more than 5 million. Treasuries are also auction additional amounts of previously issued securities called reopened securities. Like the original ones, the reopened ones have the same maturity date and interest rate, issued securities. The only difference between the two is the issue date and the price. Okay, there's tax information on this. If you're, if you're doing this individually, it's a 1099, and I've taught that in previous. There's tax implications. It's interest income. It's a T bond, a T note, a T bill, and they're only taxed at the federal level. So again, the folks who took the taxes class with me a couple of years ago, you might remember some of that stuff. And it says investors who hold federal securities receive a 1099. 50% earnings can be withheld in order to ease an investor's tax burden. So yeah, that's just whatever. Some of the tax rules. We'll save that for the tax class. Then there's a couple questions here. How do you cash a treasury bond? And what's riskier, treasury bonds or treasury bills? How do I buy treasury bonds? When should I invest in treasury bonds and bills? That we've covered all that in the previous, not to just repeat ourselves here. But those are some, and you guys can read through the default risk, and if it's who it's guaranteed by, and if it's sold before maturity, there could be a gain or loss depending on the difference in the purchase price and the sale price. And you can buy these things through Treasury Direct and opening an account and things of that nature, and your time horizon and risk tolerance, and how fast you need to be liquid. Those kinds of questions. Okay. All right, so we did 2 of these. So yeah, it's like I said. So actually, what we're gonna, just looking at the timer, what we're gonna do is we're gonna come back to this one later. Yeah, we'll come back to that later. So we did this, we did that, and we did that. Now we're gonna make we did the graph, and let's make the graph. Actually, the reason I wanted to sort of put a fork in it where we are is save this thing. I want to do another version of this here. Let's do, so the federal funds rate was relatively easy. We made a nice graph of that. Let's start doing these differences where we're subtracting. Yeah, this minus thing. So let's look at this. So this, we need the 10-year, the 2-year, and then we're subtracting them. So yeah, so this is going to be a bit of work here. So the check is, yeah, the check is the delta between these, and then it's you doing it is the check. So for better or worse, we're going to go back to the 10-year and the 2-year and see what our dates are here, because we have most of them. We have most of it already set up. So why redo it? 313. So yeah, let's get March's numbers for the Treasury for the 10-year and the 2-year. Let's get March's numbers. Only March's numbers. There's the 10-year. There's the 2-year. Okay, let's do it. See, there's the minus version of that, which is fine. Yeah, let's not worry about the minus, any of that stuff. Let's not worry about that. This is inflation based. Yeah, you have inflation indexed and not. All right, you have all that. So 23. Let's do March 1st. Daily. Let's download Excel. And you'll see how to update too with the data. You'll see how that works too. So the first, so you're going to copy all these, escape. Okay, which were there. And now down here, you just got to Control D, down, and here we'll take this copy, we'll go here, paste. There you go. All right, so you have it to the 24th or so. Now we can look just sort of, where we are here. See how I did that? Okay, so now up to 1306 pieces, 1,306 pieces of data. So where were we with this? We're again, if it's declining a bit, that means capital's piling in to this and bidding the price up a bit. But still, this is certainly more volatile than it's been, 0.78. So this, whatever this is, 0.75%. That's bigger than the last couple months. Yeah, so more volatile. You have to go back to September to get another volatility like that. See August, what August is going to look like. You had a bit of a choppy summer here, right? Okay. That's the 2-year. Now, and also what you want to do, you want to go to the graph for the 2-year, find the graph, and you have to extend your graph a bit too. You click on the line, and then what it'll do is it'll expand. You'll see what's highlighted on your column, which is right here. You see, and then you're gonna have to drag it down or just reprogram. Oh, it came with us. Oh, wait. Wait, this is what did we just do here? This is 2-year. Okay, no, that's 2. We did 10. Yeah, we care about 10. Oops, sorry about that. We care about the 10, sorry. Yeah, so this is this one, 10-year. It's 2-year. There it is. There's your 10. And see, it'll be cut off a bit. So you need to go to 1324. So you click here, 24. Click here, 24. There, and see, now you have a little bit of a new graph now. Now you have the whole thing graphed. See, it goes as far down as you went. Okay. And now we'll do the 2-year. We'll go back and we'll actually here. Let's to make the search easy. Let's just go to and let's see what February looked like in 2018. Where were you in February 2018? Yeah, see, it's not as volatile, right? That's about 1/3% as opposed to 0.75% average change in the month, or as opposed to 0.5%, right? These are the 2-year. So just copy this thing, and we'll go to market yield here. And there's a 2-year maturity investment basis. And again, we'll adjust 2023, March 1st until today. Daily. Okay, so this is plummeting a bit, right? It's at the 3.8 from 4.8. It's at a whole percent. Okay, so there's a lot of capital's piling into this. Inflation concerns, right? Inflation concerns. I mean, recession concerns. Recession concerns. So we don't need the 8. So again, we'll go to the 1st of March. We'll grab everything there. This is the 2-year. We'll arrow down all the way to the bottom. And we'll click in right there, paste, match the destination formatting. We'll bring this down, Control D, bring these two down, Control D, and we'll bring the formatting down, copy, paste, formatting. There you go. And again, I want to do just our quick analysis of sort of where we are today with this. So this is going to be, and again, I'm just sort of grabbing on these corners because I'm used to doing it, but you should really just program the things. This is 1309, so just change that 8 to a 9 like that. You can see, yeah, about a one average change is about 1%, per day. That's per day. Look at this, -12, -6. That's a lot of volatility. That's in the day. That's a 1-day swing. Okay, so you can go through and see how many other one. See here, you have 1/5 of a percent, 1/5 of a percent. So not that volatile. All right, not that volatile. Let's look at November. All right, November. This goes up to 29. So yeah, so this you're talking about a negative 1/10 of a percent or 1/6 of a percent change, right? Not these big, certainly not a percent average or something like that, right? Certainly not nothing like that. October, 1/3 of a percent daily change, more or less. Yeah, that's exactly right. 1 basis point average change in the day. Okay. Okay. You have that graph. And again, now you go to the 2-year graph there. There's S&P. So you have to keep your finger on what you did here. That's the 2-year Treasury, and yeah, we're right there. And we're gonna go all the way to the bottom here. And again, these 1326. There, so you can see it extended a bit. You can see it moved a bit on you. Yeah. Okay. You're down to 1,308 is what you're down to. Okay. All right. Now, so we have that was a lot of work just sort of updating all that. What's happening next, this other graph that we're going to work on, this is the what's used in the yield curve. You're subtracting the yield from a 10-year and the yield from a 2-year. If this goes negative, so if you have a higher yield in a year or two versus a 10-year, that means that capital is piling into the longer term securities. They're bidding up the price and shrinking the yield because there's not a lot of confidence in the future. And unfortunately, this is this is, I don't say a precursor, but it indicates it's almost always indicated a recession when you go negative. And we'll look at the point when, I think that happened in July, right? And you look at the point when that happened. So what you're going to do is we can look up the actual difference here, but also we can compute that ourselves, okay, from the work that we just did. So what we'll do is we'll just pick off the dates here. I could just take it from the 2-year, right? Shift Control down, copy, and we can roll over here, and there's observation date, paste. and you lost everything. You lost the fill, you lost all the stuff that was bothering all of us. And you can take all of these. Yeah, so this is whenever we did this was probably quite a while ago. Control D. Okay. Filling in a couple of the borders here. Okay. So now we're lucky in the sense that we have the yields to do the math ourselves right now if we wish to. We have the yields, or we have so the check is really that. Okay, the check is so we can hold off on that. Let's now certainly this you can or take the series or whatever. Now you're going to go back to the Fed site. Okay, you go to search, click, and now this is there it is. It's the difference. Now, for better or worse, we kind of have to, uh, yeah. So we're gonna have to go back to 18 January the 1st, and then daily. And now, unfortunately, we have to click through all these like we previously did, and sort of clean up all the Christmases and all that. But just be patient while we do that. Now, again, I didn't spend too much time talking about yield curves and things of that nature, but that's a part of all of this. Okay, so we're here, and we'll just click on these as we go through. Okay. Again, we're just getting rid of all these, you know, weird, weird dates in here. I don't know why we have to go through this. Why there's the technology hasn't been able updated where they just do it themselves at the federal government. But there you go. So Almost done. Almost done. 2022. Okay, so from the 1st of January 2018, we'll bring it in here and we'll bring just the numbers. And there, so that's the delta. Clean that up. And also what we're going to do here, I copy the formatting here and paste it right in there. Escape. And we'll save. And there you go. Okay. So now you have now you see it, and it was about the summer. Like I said, yeah, July. Yeah, there it is. July. So it turned in July is when it turned negative. Remember July 6th or something. So in other words, you're doing better short term, longer term. So in other words, there's a little more liquidity, the shorter term interest rates, and maybe rates are going up, and so you get, and maybe again, maybe the market's doing okay now, but people aren't anticipating it doing well long term. So maybe people are a little more invested in equities than they are in debt, and again, the prices might be lower, so they might be getting a better return, and interest rates might be going up, and so there's again a lot of forces that can influence a 2 year versus the 10 year, where people say, hey, for the long term, we don't think in a couple of years we'll be doing that well. I saw a piece on one of the websites that said the people are predicting, very experienced asset managers saying for the next 10 years we're not expecting tremendous returns, so or very flat returns for the next 10 years. How about that? Okay, so now, and you get, now here's your delta. Now here's the thing though, we can make the computation. We can say equals parenthesis. We can take the 10 year, which we have. Where's the 10 year? That's a 2 year. Okay, there's the 10 year right there. So 2.5% minus whatever this is, 1.92. So you can see that's positive. Okay, it's 0.54, and let's get a couple of these. We're pretty good. 5.2, pretty good, 5.7. Yeah, I think we're okay. And now we'll do the whole 1,300 of them, whatever it is. Control D. The dates are off a bit. Yeah, the dates are off a bit. Oops, oops, oops. So we were good for a while here. Something, it blew up somewhere along the line. 21, pretty good. We were good for a while here. Let's see what happened. But you want your dates to match up, right? So that's maybe where this could have gone off the track a bit. There's 3 month. 2, 1, 2. So maybe again, you're gonna have to go through. You can see most. You see what we're doing here, though. You can subtract those and get the appropriate answers. But you want to go through this and say, okay, are all my 31s in the same place and things and that. So what we'll do here with this, just so we can see it a little bit better. Let's take this. Again, I don't want this to turn into a computer science exercise. So we're pretty good there. For 18, we're good. 1. Yeah. So again, you have to go through, and so here 0.62, 0.62. We're okay. But yeah, you're going to have to go again, folks. Welcome to data sciences. Okay, you're going to have to go by hand, month by month, and look through all this stuff. So we're good. We're good. We're good. 6232 There we go. So we missed something here somehow. So looks like there where it started to go off. HB no. Yeah. So here we missed a couple. So what are we doing here? Yeah. Okay, so I accidentally threw one in there by accident. So we'll go so 9. Yeah, we don't have a 9.3. We don't need a 9.3. There we go. That fix it. Yeah. So I think could that have been it? Yeah. So they were pretty good. So there's the 2-year, the 10-year. Well, we'll see. Well, let's see. We might be able to fix this. We're good. We're good. We're good. 2-4, 2-4. Now these roll 2-4. Okay. And 928. Good. Pretty good. And 28. We're still pretty much on target. Yeah. Pretty good. Pretty good. This 8. And now, yeah, now we got to check the next. Now I got to check, what's going on. October, we may have screwed something up here. So let's check October 12 HBO. Yeah, 31. Okay, no, these are still pretty close. $11.30. 12.31. Goes off a bit, but okay. So yeah, like I said, you have to go through it now and see, because now you're really off here. 31. There's 31, and why that is. Are these updated numbers? We seem to have updated everything, but that it should generally work though. So don't be concerned right now if things are off a bit or something like that. I mean, that's just sort of what happens sometimes. I was a little closer with this, I think, when I did it, but still, the direction is pretty much the same. So who knows, what changes were in this, but certainly here, this is 27. Yeah, we're way off here. So only down to 24, I think. 24. See, here we're off a bit. Here's 24. Yeah, 24, 23. Something's off somewhere here. But that's how you deal with this. So like I said, so again, so you guys can go through or should go through all of this and make a good effort at figuring out what's going on here. So this we can delete there. Oh, this is 24. This is 24, 24. Okay. Okay, so there we're off somewhere. We're off somehow, somewhere here. Let's see. See it. Yeah, we're good for the 18, good for the like I said, so you're gonna have to go through, all of these. You have to go through all of these and, make sure that you have so stay in the call. Yeah, you wanna go through all of these and make sure that, you're lining up because that's all it is. Like I said, I'm not gonna spend video time, lining these things up. You guys can spend the time doing that. But you gotta make sure it all and if it doesn't line up, you gotta figure out, why, what's going on. So this one, 18, 18. Yeah, so here we're good. There's 2, 1. Like I said, but yeah, yeah, so you're gonna go through it. So, and as you see something that's wrong, you figure out what happened. There's 5, 1. We're going month by month through this. 10, 11. So yeah, we're seem to be on track here. 11, 12, 2, right there. We're good up to 19. Into 2020. Good. Well, I'll tell you, it's become a computer science exercise here. You see how the computer works, basically, right? The computer ping pongs like this. A3 was right there. There's 10, 2, 10, 2. Okay, that's okay. Yeah, even up to 2000, I think we're pretty good. Or I'm sorry, 2000, 2020. Yeah. But folks, this is how you troubleshoot. I'm telling you this again for the graduate students. I guess you guys are probably a little more used to this than the undergraduates, right? But you know, this is how you do it. Here it is. So 3, 1. Here it is. 3, 1, and 3, 2. 3, 1, 3, 1. Yeah, folks, this is up. We're good up to 2021 for 1, 5, 3. 5, 3 is good. 6, 6. 8, 2. 8, 2. Good. And 9-1 is linking up. Yeah, so we're good. We're good. We're good. Again, folks, a little bit of patience, right? A little bit of patience, and you work your way through all this. 11. Oops, here it is. Yeah. Whoops, there's your something's off. So 28. So why is that? There's one more here somehow. Okay, 10-1, 10-4, 10-5, 10-6, 10-7, 8. Oh, here we go. There's a 12 here, and there's no 12. So I might have accidentally lost one of those. Okay, and yeah, there's a 12 there too, but okay, so yeah, we're just gonna lose. We're just gonna have to do it like this. We're gonna get rid of that. For better or worse, we're gonna have to get rid of that 12. Yeah, so we're losing that 10-12 right there. So we're here with this. B. Okay, now I think we got it. So 7. Yep. Okay, so that's that may have done it. Yeah, everything else. See, there was a missing one. Yeah, there was a missing one somewhere. Okay, so this was October. Those are good. One. This is row. Yeah, these all need to be the same. Why aren't they? These all need to be the same row. There we go. That's it. We got it. Now we're good. 324, 324. Yeah. There it is. Okay, so I can sleep at night now that we got this right. Okay. Folks, it takes, that's what it takes. It takes that level of being fussy with this to make sure that so now what you computed and what you computed and what the website gave you, the Federal Reserve website matches. This is the current minus the previous. You guys know this stuff, right? And this is that delta divided by previous given. So you had a 7% change in this. A lot. There we go. All the way down. All the way down. Yeah. So wow. So this difference has moved 20%, 28%. So it's good we studied this. Wow. Okay. These are some movements. This is certainly, unfortunately, I'm not gonna be able to keep going because I have a meeting I have to get to. But yeah, I mean that's all right. That's a lot. Look at these that's a lot of volatility in this. That's a lot of volatility. You want to go through, right? Clean up everything, your borders. Like I said, I'll let you guys work this out on your own, but you got to go through this thing and clean it up. Okay, you never want to leave it sort of how we have it now. You never want to leave it like this. Yeah, so some of the ones up top, these are going to be okay, right? You're going to go all the way through with this thing, and you want to be able to read across like this. Okay. And then you can do average change. You can do all that, but certainly you guys can see here as you go down to the bottom here that we have, and we'll fill this in, like I said, and if because I have a meeting I have to get to, but another meeting, but you could see how you're looking at this, right? So you want to do your average. So these are big swings. These are big swings. Oops, undo. That's your average delta right there. You're going to get a big average change here. Whoops. I don't know what happened here. Why it's doing that, but there. That yeah, about 2% average swing. That's a lot. That's a lot. So okay, whoops. Something else up here. Yeah, this thing, because they're the same on that one day. This is the day when these things flipped. So yeah, like I said, but you go through and you clean this thing up and you can make the graph. We just did a graph, so I think you guys are okay with the graphing. But that's an important part of it. You got to be able to make the graphs for these things, and actually here with this, and we could use the ones that are given to us. Um, we could just grab the market change here. This is this one, copy. We'll do the sort of the short version of this. This is market yield on treasuries. All right. 10-year minus 2-year. And this italics, maybe make it smaller. I've done it like that, something like that. Okay. And you can click on this. And now this is, instead of BD, this is CF. CF. And this is CG. CG. And also, you want to go to the bottom of this thing and make sure that we're good. Okay, we went all the way. And find your column of graphs here, and you want to add another tiger tank, right, to what you're doing here. And it's the right size and everything, so you should feel good about that. Okay, but there it is. There's your marquee on the 2-year minus the 10-year, and actually, let's see. Yeah, here it is. Okay, I just did it like that. Difference percentage. Okay, so, and this is edit. This is all right, and that's what you got. And what do we call this thing? Yeah, I don't know if it's yield anymore. It's really, this is really just percentage. All right. But that's what that looks like. All right, you can save this, and I think we did pretty good today. We've got a lot, we spoken a lot, but so obviously when this goes negative, you're doing better now than you would long term, which is really not how it's supposed to work. And you saw the theoretical descriptions that we just had, where it said, oh, you have a longer maturity, you should get a better return, but that's not what's going on. Okay, and there's an unfortunate sort of conclusion for things like that say, hey, we must be in trouble longer term if people are jumping in. The prices are going up for the longer term maturities. Capital's jumping into that because it doesn't have confidence in the equity markets. So that's kind of where we are. So, okay, we got a lot done today. We got our graphs done. We and you saw you need to be a little computer sciencey. You have to be. And like I said, my morning guys, I think the graduate students, I think are going to be okay with that. But the undergraduates, I know you didn't sign up for a computer science class, but that's about what this is. Like I said, then you can go through all of this and see how this normally behaves. So not big swings, right? Not big swings at all. Percentage wise, 1/10%, 0.2%, not big swings at all. So let's look back to 2018, what this was looking like. Yeah, I mean, this was, oops, let's go all the way. And this is the average change, and actually this should be the delta. Whoops, that should be the delta, which is right there. Yeah, so those are actually 0. And actually looking at this, we need to go through all of these. I have a feeling we messed up a bit on some of these. Let's check this out. Yeah, we messed up a little bit on some of these. Okay, so we're here with this. You want to come across? Some of these, it's a 50%. change. Yeah, that's a big change. Some of the certainly in the summer when this was flipping, right? We had big movements. 12% average daily change. It's a lot. Of August. Yeah, the reason these might need to be like 4 decimal places to see the change. See, you're not going to see the change. You can see the percentage, but you can't really see the change. Like I said, fix these, move them. Okay. And like I said, now you go down to the bottom, and like I said, you see these anomalies here. You divide by zero somewhere, or something like that. You got to be careful with that. There, this thing divide by zero here. That you want to get rid of that. These you want to get rid of those. You can see that you can have big movement. Like I said, it's in your interest to really go through all this and to really figure out what is going on here. Yeah, oops, there we go. This is there. Here. Increase some of these, and away we go with all this. See what we're doing here? We just keep going through it all. Okay. And you can see the movements in these numbers and the delta change, the delta, whoops, delta change that you have here. So again, you're some good computer science skills, and that's never hurt. Never hurt. There. And like I said, you guys can finish the rest of this on your own, but you see what you have to do, right? Make it 4 decimal places. And like I said, you can go through and finish the rest of these. We did enough of them for you guys. Okay. Do this one, and that's it. There are your main numbers. There you go. Okay. But you can see that there's big volatility in this. This is like how the yield curve changes. And you can see, obviously, we've had some big swings. Look at that, right? We've had some big swings in there. So obviously, this is certainly something to monitor. All right, folks. Thank you so much.